Welcome to the Debunking Economics podcast with Professor Steve Keen. I'm Phil Dobbie. Today, interest rates, have they anywhere to go? Interest rates have been low in most parts of the world for some time now. In many places, they're actually negative. So what do central banks do next time there's a global economic downturn? Which, as we discussed last time, isn't very far away now. That's this time on the Debunking Economics podcast. So interest rates in most parts of the world are at record lows. In Switzerland, for example, the current rate is minus 0.75%. It's been there for 4 years. Sweden and Japan are also in negative territory, while the Eurozone, governed by the ECB, of course, the European Central Bank, is on a flat zero. And Japan has barely been in positive territory this century. So when will it rise, if ever, and what are the consequences? Well, let's start with an obvious consequence, Steve. I mean, low interest rates create debt because people think it's cheaper to borrow, but that's perhaps a bad thing, but surely also it means people spend, which is a good thing.
Well, I think they're doing neither, unfortunately, because when you're carrying, if interest rates were zero and debt was also zero, you wouldn't think twice about taking out a loan. Interest rates are almost zero because debt is massive compared to income. You have 1.5 times GDP in America, more than twice in Australia, and so on. And then virtually 2.5 times the places like Denmark and so on. So the low rates, yes, they make it enticing to take on new debt, but there's so much debt out there already.
That's why it's there. Yeah.
Yeah. Okay.
So how do we get to that stage then? Why did we all of a sudden start borrowing to the point that central banks had to drop interest rates so significantly?
Well, I think because the central banks and the governments in general basically said debt's a good thing. This is one of my main complaints about neoclassical mainstream economics. They effectively demonized equity and enhanced debt, because the way they teach this is the thing called the capital asset pricing model, which is their overall way to try to interpret what happens on stock markets in an equilibrium way. And as part of it, they have what they call the Modigliani-Miller hypothesis. And this simply says that if you they ask the question, does the level of corporate debt affect the valuation of a company? And they say, no, it doesn't, because it's quite possible for a highly levered company to be bought by somebody, have its shares being bought for cash, or a lowly levered company to have its shares being bought by people who borrow money. Therefore, on that a priori argument, there's no relationship between the level of corporate debt and the level of share prices. Now, that is absolute and complete empirical bunkum. Well,
you'd look at growth as well, though, wouldn't you? So you'd say it's okay having a highly leveraged company if it was growing very quickly, because obviously investing to fund that growth.
Yeah, but none of this gets into this mainstream theory. It's all thinking in terms of equilibrium, and it's thinking in terms of rational agents who can offset what other rational agents do. So the whole idea is to neutralize any role for the government in the economy. That's the ideological bias of this economics. What they pretty much said was, with the Modigliani-Miller, if you get an interest rate deduction on your tax payments, which you don't get an interest rate, you don't get a deduction for your dividend payments, then the best situation for a corporation to be in is 100% debt finance and 0% equity. Now, that was a major part of the ideological backing for the whole leverage buyout world that was the 1980s in particular, the greed is good period, but it still hasn't gone away, and in this sense have actually encouraged corporations to take on that level of debt. So to me, it's been a bad economic theory leading to a bad idea that should mainly be debt financed, when for robustness, and this is something that Nassim Taleb talks about very eloquently, the height of anti-fragility, the more debt you have, the more fragile you are. The more equity you have, the less fragile you are. So we need a less fragile world which relies more upon equity and less upon debt. Yeah,
it's interesting, isn't it, how even mainstream economists are very divided on all of this. So let me give an example. Paul Krugman versus David Malpass. So David Malpass is the economist who's been nominated by Donald Trump as the chief executive for the World Bank, who was arguing several years ago that the US should lift interest rates because otherwise we're going to see a surge in asset prices. Well, guess what, David? Too late for that. Paul Krugman, who I know you love dearly, he's criticized Malpass because he says he's got this concern that low interest rates discourage thrift. which he says is bad for the economy. So Krugman definitely fits into that camp of no, keep interest rates low so people borrow more, so that helps growth in the economy. But here we've got a man who's sort of like going to be in charge of the World Bank, who's thinking, well, maybe it should be, sort of saying, it should be the other way around. At least certainly, interest rates need to be higher, so we try and discourage that sort of behaviour. But the horse is bolted, of course.
Yeah, I think what we're in now is a low interest rate world, whether people want it or not, because any increase in interest rates is going to cause the private sector to fall over. And this is the point that Paul Krugman will never get his head around, because he's still thinking in terms of loanable funds. When you borrow money, you increase your spending capacity, but the person lending it to you reduces theirs. And then when you pay it back, the person who borrowed has less spending power, but the person who lent has more, and one balances the other out. And that means that there's no significant impact on aggregate demand with the independent level of private debt, which is, unfortunately, to use a technical term, we can use these words on the podcast, bullshit. Is that okay?
Yeah, okay.
That's okay, good.
I love podcasts for that reason. You can say what we want. Right.
Yeah. No radio regulator getting in the way.
No big red button here. No.
When you say there's banks create the money, they write an entry on the asset side creating a new loan, they put the same amount of exactly the same number into your deposit account or into the account of the person you're buying something off as the liability of the banking sector. That growth and expansion of money increases and decreases demand equally as well. So you don't have a capacity with low interest rates for people who are borrowers to counteract the lack of spending by those who are lenders. What you actually get is low rate of growth of credit and low economic performance. And any putting up of interest rates will encourage people to pay debt off, which reduces the money in circulation and reduces demand as well. So you're locked in where you simply can't let rates get off the floor. And I think the long-term history of interest rates, until the levels of private debt fall for whatever other reason, it won't be conscious policy that does it, the long-term prognosis for interest rates is to remain low. And any uptrend is a chance for anybody who is in the bond market to speculate on the rates falling again.
Yeah, you make a lot of money doing that sort of stuff. But I'm just wondering how bad long-term low interest rates are. Okay, obviously there's that whole issue about asset bubbles, but there's good debt and bad debt, isn't there? So in theory, if you've got low interest rates, then that encourages you to take risks with your borrowing. So, and risk taking obviously creates innovation, which can create future growth.
If the money goes to innovators, but the trouble is it goes to speculators with the modern banking sector. Yeah. And this is the major problem that I see with leaving the banking sector.
But it's still the speculators are still taking risks, though. So they would be speculating. They're taking risks. They're taking risks all the time, but they would. Presumably, there's going to be a high return for taking a risk on something which is quite innovative. I mean, are they two mutually exclusive?
Well, it's actually a lovely distinction that one of my favourite economists, John Blatt, the old professor of applied mathematics from Australia, made the case in trying to argue against net present value thinking in terms of evaluating whether you should purchase an asset or not. He said you have to distinguish between investment, what he calls placement. He said investment is something where you buy fixed capital. You're actually building a productive factor of some description. Yeah. Placement is when you buy shares. I have a personal, I love embarrassing my brother-in-law on this front, lovely guy who's got a very strong ethical attitude to investment. And he decided his self-managed superannuation fund would only hold ethical investments. And I didn't have the heart to tell him that he was buying shares of other speculators. He wasn't getting any money to people like Cochlear in the first place, because it was the second-hand market where you buy
makes no shares. Difference. Yeah, exactly.
So this, if you have money going to people who are doing a placement game, then what you get is volatility in asset markets. You don't necessarily get innovation, and that to me is the major weakness of the banking sector. I would far rather see the banking sector providing working capital to existing corporations and innovation capital to entrepreneurs than doing what it's doing at the moment, where it basically doesn't provide any money of any real substance to the corporate sector in the way compared to what it used to in the 50s and 60s. It just basically lends people to gamble on asset markets.
So really what he should be doing is buying corporate bonds, shouldn't he? Because then he would be helping the company. But look, if you want to hear the full discussion, there's lots more to this discussion on interest rates with Professor Steve Keen, then you need to subscribe at debunkingeconomics.com. If you subscribe, you'll get access to this and all the other podcasts in this series, or you can become a supporter of Steve Keen on Patreon. All the money you pledge will help his work in changing the fundamental thinking of economics. And if you pledge more than $10 per month, then you'll get access to all the podcasts as well. Go to patreon.com/Prof Steve Keen. Hopefully you'll do that, and we'll see you back here again very soon. I'm Phil Dobbie. Thanks for listening.